So we are getting close. We are down to our last two sessions, and importantly, this one is the presentation of the results of the 2017 Conference of State Bank Supervisors Survey of Community Banks. There will be a PDF version of the publication that lays out the results that will be in your email boxes shortly. So to do that, I'd like to introduce two individuals. First is Mike Stevens, who's Senior Executive Vice President, that's a pretty cool title, of the Conference of State Bank Supervisors. And Mike leads the CSBS Public Policy, Financial Supervision, Federal Coordination, Communications, Industry Relations, and Professional Development functions. He told me not to read all that because John Ryan would say, hey, what do I do? Sorry, Mike. There went that relationship.
Nothing is sacred, is it?
Nothing sacred. We do have a good time, though. With John is Andy Meyer. Andy is a senior economist in the St. Louis Fed Supervisory Policy and Risk Analysis Unit. He received his PhD in economics from Washington University in St. Louis, and importantly, conducts research on community banking for our Federal Reserve Bank. So I will turn it over to both of you.
Thank you.
So as Julie said, I'm the former Senior Executive Vice President of CSBS. All right, so welcome to the Mike and Andy Show. As we've developed a reputation over the last 5 years. So we are here to release the 2017 version of the National Survey and Banker Outreach. I'd like to thank the commissioners, state commissioners, who do a lot of work, them and their staffs do a lot of work to push out the National Survey to their banks. And also conduct the banker interviews, what we call the 5 questions for 5 bankers, or for states that prefer to do the town hall meeting. The banker engagement, the industry engagement was always going to be a hallmark and a critical component of this conference from the beginning. Really, you've heard us talk about before. We're really pleased with the reputation that this booklet has as a kind of a one-of-a-kind look at the industry and what you all are thinking, both positive and negative. And there's a lot of positive in here about how community banks are planning for the future. So, do you need to give your disclaimer?
Oh, I do, in fact, yes. While he speaks for the CSBS in totality, I do not speak for the Federal Reserve Bank of St. Louis or the Board of Governors or anyone associated with the Fed. I just need to make that disclaimer up front. Thank you.
And my disclaimer always is that the views that I express are probably more moderate than the commissioners that I work for. So. That never gets old. So, okay. No. We're gonna kick this off. We're gonna highlight a few pieces, sections of the survey and the qualitative information we get from the interviews. We're gonna focus a lot today on the small business lending piece of the survey. You go back to the original. The foundational idea of this conference was to better appreciate the role and understand the role that community banks play at the local economy, and no place do you see that more than small business lending and really understanding how banks do small business lending. We've seen a lot of that here over the last couple of days. And I know that the FDIC is getting ready to release their SBA or their small business lending study early next year. So I think that we're making significant progress in terms of kind of better understanding how community banks do this business and the impact that it has on the economy. Now, this didn't come from the survey. It comes from our standard slide deck that we use at CSBS. And this is just based on the call report data, but Andy and I inserted this in here because it's a very popular chart when CSBS staff present. This is based on the call report data. It's often referred to as small business loans. It's actually small loans to businesses, but it's the best call report data that we get. It does allow us to, so it's not perfect, but it does provide a little bit of a glimpse when you look at lending exposures, small business versus the rest of the loan book, for banks of various asset sizes. Breaks it down into 6 different asset buckets. And so we see that, as you would expect and hope, that smaller institutions dedicate more of their loan book towards small business lending, and it just declines as you go down the scale. Now we also know, and again, you've heard it a lot this week. You're going to hear more of it as Andy and I progress. But we also know that the smaller institutions do small business lending very, very differently than the larger institutions.
Which brings us to the next slide. This is from the survey, and where the figures come directly from the survey, we've preserved the figure 2. So just in case anyone's following along, you can see this is figure 2. We are not by any means going to go over the 59 different figures in the survey in the booklet, but we do want to pull out a few highlights. One of which is this one, just showing that what proportion of small business loan, what proportion of banks define all of their loans as small business loans. That's 37.7%. 30.5% define a small business loan for their internal record-keeping purposes as based on the size of the loan. So that one does line up with the call report. But another 27% base it on the total revenue of the borrowers. There are a few that do the number of employees of the borrower. So the measure in the call report is a very rough proxy of the actual loans to small businesses. As Mike said, that schedule really is small loans to businesses. In the next couple of figures, we see the great importance of prior banking relationship to these community banks. This will come as a surprise to no one. By far the majority of banks consider a prior relationship when making a small business loan, when they've been making those in the past. And as the next slide shows, that result is not going to go away anytime soon. It's also true that the fundamentals are very important in lending to small businesses. Now here we've combined the percent that are very important with the percent that are important, but we see things like financial statements, credit score, business alerts, business conditions, all very important in the underwriting of small business loans. Prior lending relationship is still right up there with 60% of the banks consider that very important or important. And way down at the bottom, the credit score of the business itself. Now this is not of the business owners, but it's notoriously difficult to come up with a one-size-fits-all credit scoring model for small businesses. And the good news about that is that's what keeps the big banks from coming in and taking all those loans like they're doing with credit cards and with mortgages, where you actually can use a credit score for individuals. Very difficult for small businesses, as I'm sure you all know. This is going at that same question in just a slightly different way. Here we're talking about the percent that always or usually require business collateral, other collateral loan guarantees, or business owner's collateral. Again, related to the last question, but just going at it from a slightly different angle. Here we're looking at the frequency of small business loans backed by the SBA. We learned in the last session why that's a little bit difficult. You have to jump through a lot of hoops and show you can't get the loan other ways. And so we're seeing that 30% of banks never do any kind of SBA lending. And even the ones that do, they're 53.8% never, about half the time 12%, and very few just dedicated SBA lending specialists. So while that's a very good program, as we've seen in the last presentations, it's not all that prevalent in practice.
So when you dive into the commentary for what bankers are saying about small business lending, on the positive side, regional banks are a primary competitor, but it's easier to compete against them because their product offerings are so rigid, and that community banks can really work with customers who don't fit into a box, and we saw that in the commentary from the video at the start today. On the negative side, and I think this is really interesting when you think about Cynthia's presentation last night and the discussion today around small business lending and the use of the SBA. A lot of comments about SBA taking too long and too cumbersome, and then having to compete against larger institutions that may not have to take the SBA guarantee to be able to manage the risk. So it seems to me, I think there's something better to understand about who SBA works for in the community banking space and who it doesn't work for. Because it seems to me that when you listen to Cynthia, when you listen to Peter, you either do this business and you do it well, or it just maybe doesn't function very well for you. I think that's something probably better to understand. And obviously, when you have too many dollars chasing too few deals, it does lead to a competitive marketplace and leads to concessions. And we'll look at some of that information in the survey data. And then going forward, banks are very concerned about the CFPB's data collection, a potential rule for data collection as required by Dodd-Frank, and we'll see that show up a little bit later in some additional commentary.
All right, so speaking of competitive pressure and concessions, what kind of concessions are bankers in our survey making based on competition? It turns out the biggest one is if the bank down the street offers you a lower interest rate, I'm likely to match that. 20% of banks always or usually do that. Next up is fees. You might cut some fees a little bit if based on the competition. At the tail end is reducing collateral requirements. Only 3% of banks always or usually do that. I think I might be speaking for the Federal Reserve when I say I approve of that. That you don't want to. That's not something you want to cut back on just because the competitor down the street is willing to do so. Now, this next couple of slides is interesting in terms of current competition. All the community bankers in the room will recognize this pattern. Who is your greatest current source of competition for small business loans? It turns out that it's small community banks, and the smaller the community bank, under $1 billion, the more likely they are to be your main source of competition. Followed by mid-sized community banks, then regional banks, then large banks, and with not much left over for all the other categories, credit unions, fintech, farm credit, obviously not a big player, or other non-depository institutions. But we also asked, what is your greatest source of future competition? Well, here we start out with small community banks, mid-sized community banks, but then credit unions actually jump up to third. They've increased their share here by a factor of 3. So banks are, while they're not terribly concerned about credit unions in the current environment, they're very worried about them encroaching in the future. And then the other big jump is fintech firms, which went from almost nothing up to 6.9%. So bankers are clearly worried about these two types of competitors in the future. Which brings us then to mergers and acquisitions. When we first did the study in 2015, we determined that 11% of banks, of community banks, had received an offer in the last year, and 22% had made an offer to another community bank, presumably of a similar size or smaller, in the past 12 months. And we weren't quite sure, is that a big number or is that a small number? It's certainly much bigger than the actual transactions and mergers that took place, because these are all prospective deals. Did you make an offer? Maybe the price wasn't good enough and it got turned down. Maybe the regulator said, no, there are competition issues and we're not going to let you do it. So it's kind of interesting to see a time series of these numbers, and it turns out that this is a fairly stable measure. In 2016, we went from 11% to 10%, back up to 11% for receiving an offer. There's a slight downward trend in making an offer, 22 down to 20, down to 19. I'll be very curious next year to see if that's 18 or 17, or if that jumps back up to 20 or 22. So it's kind of nice to see a little bit of stability there, so that it gives us a little bit of confidence that we're measuring what we think we're measuring. So why might you consider an offer? We've had a lot of discussion about this in several of the session, inability to achieve economies of scale. So, and then one of those aspects is embodied in the next one, regulatory costs. If there's any fixed cost built into regulatory compliance, then the bigger the bank, the more you can spread that fixed cost over, and that's true of just about anything, building branches and all that. And then succession issues would come in third in terms of reasons why you might consider selling out. Not that selling out, I don't want to make that a pejorative term. I sell out all the time. What might be your drivers for making an offer? The number one driver would be entry into a new market, and then followed closely second by expansion within a current market, and then to exploit underutilized potential, and finally talent acquisition. So these are some of the reasons why you might want to expand. Now, yes, so those are the major drivers, and I'm going to let Mike carry on for a little bit more on consolidation.
So you provide a little bit of kind of perspective on consolidation. I thought it was interesting. Look, we often talk about the industry shrinking. We've had a lot of consolidation during the crisis, post-crisis. But even it kind of shocked me a little bit when you added it up over the last 5 years that we've lost over 1,400 banks in one way or the other, 20% fewer charters. That's just pretty daunting. But most common there's a series of questions that look at different types of areas where you'd have competition, the small business loans and deposits, et cetera, commercial consumer loans, and where you get competition. When you add it all up, the greatest competition for a community bank is other community banks, and that's been pretty consistent in the time that we've been doing this survey. But it's interesting when you go through some of the commentary in these reports. You'll start to see some comments about this consolidation is actually kind of clearing out the field a little bit. And it's providing a little bit of breathing room for some banks in the communities in which they operate by kind of taking some of these banks out. I was talking with one of you earlier who talked about this effect and some of the consolidation, and made the point about the further away that home office gets from my bank, the better off I am. It's easier for me to compete and work in my market. So you start to see at least maybe some positive comments from those that remain in the marketplace of what consolidation is bringing. One of the issues on why that was in the survey as to why you might seek to sell your institution was around succession planning. You hear a lot of this from you all, from the industry, about the challenges you have of attracting and retaining talent, the ability to get the proper board in place. And so the case study competition, we saw the students yesterday, the case study competition was focused on succession planning. And really the goal of that was to try to cultivate and find out what banks are doing, what are their different strategies to address this. So I was surprised it ranked really quite low in the survey. But I think that the 33 case studies submitted does provide a volume of work for us to maybe spend a little more time with and cultivate what institutions are doing. So you're faced with this, how you develop staff internally to be able to, assume greater leadership within the institution versus the ability to attract from the outside, do some external recruiting. I think clearly community banks, relationship lending model, a relationship business model that you would expect is that they want to be able to hire and develop internally. So a lot of talk about rotation programs, how you rotate people through the banks. This is really kind of old style banking that still very much can work. Board composition and diversity, I think this is probably a very significant change for community banks and probably very much for the better. But instead of having the model where it's kind of the business leaders of that community, and increasing pressure to make sure that you have the financial expertise on your board, that you've got somebody with a technology background, maybe a compliance background, a cyber background, that how do you bring that additional expertise within the institution as risks change and as the model continues to change.
All right, so that brings us to a section on supervision and regulation and some of the explicit costs. This particular figure is not in the table. This is based on some research that we presented at last year's conference that basically just shows graphically and somewhat starkly just how much higher a percentage of banks' non-interest income is spent directly on compliance in all of these different categories. It turns out that in the 2015 survey, 22% of community bank net income was spent on compliance as identified as compliance expenses by community banks. In the 2017 survey, that number had jumped up to 24% of community banks' net income was spent on compliance. That's a figure that's roughly $5.4 billion. And we are in the midst of a research program that's basically looking at this time series and trying to tease out what's driving some of those changes and what exactly those changes are over the years. But this is something that's really quite stark too. If we look at the greatest challenges just from one particular regulation, the TILA-RESPA Integrated Disclosure TRID, which is an acronym of an acronym. Our regulations are getting so complicated we can't even have single acronyms anymore. But if you look here, increased staffing costs is only fourth on that list. So in the slide before, you saw how high those compliance expenses, but that's fourth, following increased regulatory liability, delayed closings, slower pace of business. So the explicit costs are just a part of the regulation expense that is being thrust upon community banks. Some of those regulations are doing lots of good things. Making sure you have enough capital, for example, that's a good thing. But we have to recognize that they do impose costs. What kinds of costs are being imposed? In particular, Figure 30 shows the percentage of compliance costs due to specific regulations. It turns out that the number 1 and number 2 have flipped from last year. Before, TILA-RESPA was the number 1 and then followed very closely by the Bank Secrecy Act. Those have flipped, but those 2 are by far the ones that banks perceive the greatest expense in terms of their overall compliance cost program. Way down at the bottom in this particular case is Basel III because the community banks tend to have plenty of capital anyway. That's not really a binding constraint for them. I'm sure if we ask banks over 50 billion or over 250 billion, we'd get a different ordering, but this is a community bank survey. So I'm going to turn it over to Mike to talk about why bankers dislike BSA and TILA and some of those other things.
So I picked up on the quote about having as many BSA staff as lenders. From what I hear, I don't think that's just hyperbole to make a point. I think that is a reality for many institutions. But I think we're going to have to take stock. This has been, the last couple of years has been a dominant issue that has come out of the interviews with bankers. It's time consuming, and then you have to wonder if the tools that are available that they're using are kicking out so many dead ends. Are we really achieving the policy objectives? So look, this is an issue of national security, so we're not going to do away with BSA, but we should make sure that we're getting the results that we need. If bankers are going to have to spend so much time and energy with this, we probably don't have the right tools in place or the right approach. It does seem we are kind of reaching a little bit of a tipping point on this particular issue. I also took note of and something to think about from a policy standpoint, that anytime they have to adopt one of these programs, it's just one more program that then needs an external audit. So I think we got to think about that in terms of our regulatory approach. So when it comes to TILA and RESPA, I loved this quote, stranded with children, pets, and a van full of furniture. So it's funny to me, but I suspect that's not funny if that's you, right? There's a fair number of stories to probably support that. But I couldn't resist the second quote of absolutely exhausting. That seems to be fairly consistent with what you hear from folks. But even more seriously, a little more important, the idea that the feeling that the integrated disclosure has fundamentally changed the relationship model and the way that you're able, or maybe not able, to serve your customers is something that I think we need to better understand and appreciate. It shouldn't be really the outcome, I think, of public policy. Difficult to explain why you're sitting there with a van full of furniture and everybody in the car. And then an impact on credit availability. So this is my call to the industry. If this is a real issue, you need to be able to start talking about who you're not able to serve. What types of loans are you not able to make? What types of consumers are not getting credit? And then the more that we can talk about that, the more that we can quantify that, that will have an impact on public policy. So there would be your to-do. If the current state isn't enough, clearly bankers have other issues on their minds when you start to think about the new current expected credit loss provisions under FASB, and then once again the HMDA style reporting on small business loans that's required under Dodd-Frank. Clearly on the minds of bankers of other things that they're going to be having to deal with in the future. So when we look at technology, we've always kind of referred to technology as the double-edged sword, and that is comes out again in the outreach with the bankers. So on the downside, banks feel a lot of competitive pressure in this space to push on the technology front because of competition. It is increasing costs. And at the same time, increasing the regulatory expectations over IT for reasons that we all know and appreciate. When you think about this competitive pressure to deploy new and better technology, that does come with a risk of what happens if you deploy the wrong solution. You've just really amped up your cost as you try to fix that. And then really, what banks are, I think the way to summarize this, what banks are faced with is how do I balance staying competitive while protecting my customers and deploying the right solutions. Now on the upside, by and large, look, I know that there's a lot of debate and a lot of questions around what's the relationship between a traditional bank and these fintech firms. But I would say by and large through the report you see more optimism about potential relationships and partnerships between fintech and traditional banks. So I think that's a positive in that it's a sign again of banks kind of looking forward and seeing where opportunity may exist. I thought this might be a little sad, but I guess it is a competitive marketplace. Capitalistic society is that for those firms that aren't able to keep up, it does provide a nice acquisition target. I thought that was interesting. And also the other hopeful point that came out in the commentary is the feeling that I don't have to lead on the technology front. I've just got to be able to kind of follow quickly and keep up, but I don't have to be on the cutting edge. So those that are feeling the pressure on the technology front, maybe that buys you a little bit of breathing room. So kind of looking forward on the technology front, the 2018 case study competition is focused on banks and technology. And it's not banks and fintech, it's really banks' use of technology. So could include fintech as we think about fintech firms, but it's just also about how they deploy technology in the firms, how it works within the strategic plan, how they do vendor management. So we think that this is a really exciting element of the case study competition for 2018, and we'll be really interesting to see banks of different sizes and different locations and how they're deploying and how they're thinking about technology. So Amanda Holcomb from our staff is our project director this year on the case study competitions. You got questions? See Amanda. And we look forward to having universities from all your states participate. So that is, I think we have like a minute maybe to take a question or two.
or corral us later.
Commissioner.
So Mike, in your viewpoint, any one takeaway, a punchline takeaway from this year's study?
A punchline takeaway.
I might have one.
Okay, good.
I was just noticing that in the very first survey, in terms of just the open-ended questions and the comments, people were much more anti-regulation than they are in this most current survey. Now, that's not showing up in the explicit costs, but when we did the survey for the first time, Dodd-Frank had just passed, and the Fed and other agencies had only written less than half of the total rules that were coming out, and there was huge amount of uncertainty, and bankers, above all, hate uncertainty. And so it seemed like there was just a constant torrent of negative comments there with qualified mortgages, ability to repay, and all that. Now that things have settled down a little bit, we're a little bit more in the steady state. We're actually talking about rolling back some of the regulations. Some of the vitriol has decreased just in terms of the open-ended questions, if not in the explicit cost. So that was one thing I noticed.
And I would just circle back to my competition point. I think that's kind of interesting, just as how some of the markets might be changing with some of this consolidation. Real quick, Mel. Oh, sorry. Commissioner Hall.
And I was trying to understand, is this an actual cost, something that someone's paying because they have been sued or they've had an enforcement action, or is this a dollar value that people are placing on fear of the unknown?
Yeah, I guess it's possible we should reword that question just to make sure the bankers are all answering that consistently. But in terms of increased regulatory liability, one could interpret that either way. I don't know. Do you have a strong view on that? That's something we should maybe look at just to see if, were you sued and you had this, maybe you had to pay something to the Justice Department or to a community group. As far as I understand, they've cut down some of those payments that go to places other than to the regulator. But bankers might have answered that if they had actually made those payments, or it might just be having to lawyer up in anticipation of those payments, or just expected value of those payments. That's a good question. We should look into that.
The top percentage, 3.3%. So it's a significant expense, and we're just trying to figure out,
Yeah.
Is it a real expense or is it an expense of concern?
Right. Yeah. No. Unfortunately, I can't get into the heads of the people who answered that, but we should look into ways to maybe make that a little bit more clear.
All right, thank you very much.
All right, thanks. Thank you.